We talk about the price performance in percentage terms, up 30%, but it's really difficult to get my head around the idea that gold started off the year trading at 2,600. We're now very close to 3,600, 3,500, thereabouts, all-time record highs. And yet you remain bullish on gold. What is going to drive the next leg up from here? We've already rallied so much.
Yeah, that's a great point. There's absolutely massive spending on gold if we look at it in a historical context. You look at the value of the gold spending at the moment, and it is running at about $600 billion annualized, which is well over 0.5% of GDP, the highest in almost 50 years of data. So yes, there is a huge amount of gold buying. I think what takes it higher is that buying is set to continue. And so what the gold market's trying to do is it's these new buyers, the people who, they're buying for a variety of reasons, and we can talk about that, but the new buyers are trying to get the stockholders to sell. And on our estimates, you're trying to get a lot of stockholders to sell. Around 1% of total stockholders are needing to sell their stocks to clear this market, to meet that fresh demand to buy gold. So those stockholders, over time, the weaker hands sell and the stronger hands want higher prices. And that's what we're seeing. We're seeing gold kind of move up to get those stockholders to sell that marginal unit.
Yeah, to what extent is where we go from here dependent on what happens on the macro side of things? And let's say that the Fed don't end up cutting as much as priced in, or inflationary pressures don't emerge to the extent that perhaps some people in the market are anticipating. Does that constitute a headwind?
Yeah, it certainly does, and that's part of the reason why we only see a small amount of upside in the baseline scenario over the next 3 months. In that scenario, we do see prices getting up to $3,600, and that is because the FOMC has a dual mandate, and inflation is above target. Yes, the growth market's slowing down, or the labor market's slowing down, but it's not slowing down dramatically. It's been slowing down for 3 years. The slowdown recently is kind of a bit of an acceleration in that. But overall, the US economy is doing okay, and the Fed has a dual mandate. So this is something that is going to be supportive here.
Yeah, Max, earlier in the year, we were talking about how silver wasn't enjoying the same rally as gold, gold's cousin, if you want to call it. But it's broken through $40 an ounce now, levels not seen since 2011. First of all, why did it take silver so long to catch up? And are you as bullish on the outlook for silver as you are for gold?
Yeah, I think the fact that gold got to record highs and it's gone up so much this year has resulted in some investors shifting into silver as a leveraged play on gold. So investment demand for silver has picked up in particular over the last 3 to 4 months. On top of that, you have a genuine deficit market in silver. And that deficit market has been ongoing for some time. It's not a true deficit, kind of like gold's deficit that we spoke about earlier. You're trying to price the marginal silver stockholder to sell their inventory to new investors, and they're requiring higher and higher prices as well.
Yeah. I want to switch over and talk about oil because we've got this OPEC Plus meeting coming, and I'm sure you heard our conversation with our prior guest. But I saw your view, the Citi Health view, is you're sellers of rallies in oil above $70 a barrel, but you're buyers sub $60 a barrel. So really, I'm guessing you see this target range of around 60 to 70. Why not more bearish? Because so many analysts that I speak to have started revising their forecast lower as we get into 2026 on anticipation of a supply glut.
Yeah, so the first reason is we're not seeing these builds to match the surpluses, the headline surpluses that we and it looks like a lot of other people are modeling of 1 million barrels plus. They're not showing up. And that makes you concerned that perhaps demand growth, the level of demand is higher than pretty much everyone is modeling. or that, for example, China is stockpiling a lot of the surplus. And so what if the demand level, stays higher than expects, or China continues to stockpile at the recent pace? If either of these things happen, then this surplus, not just last quarter, this quarter, it actually doesn't show up to the market in terms of OECD builds. That, certainly our baseline is that China's been stockpiling a lot of the recent headline balance surplus. And if that continues, then we're not going to go as low as consensus believes.
Yeah, so interesting. I want to round up with a question about tariffs. And of course, now there are questions about the reciprocal tariffs, but not the sectoral tariffs, which apply to a lot of the commodities that you cover. Do you feel like, markets like copper, aluminium, steel have now fully priced in the scale of the tariffs that were applied by the Trump administration, or there are still some dislocations?
Sure. So in the major metals that President Trump has spoken about, whether it's copper, aluminium, or steel, I think, yes, the market has priced the tariffs. But in the other metals, which are part of the Section 232 on critical minerals, that's where we could see some really interesting things over the next 6 weeks before that information comes back. In particular, palladium looks vulnerable to being tariffed, and that could see up to 50% upside in the COMEX palladium price. So that's silver as well, but more so palladium, given the anti-dumping concerns, given the concerns about domestic production having come down over the last few years due to low prices. I think that's an area that could be very interesting for investors.